The stock market dropped sharply this week after the Federal Reserve raised interest rates by another 75 basis points to 3.75 to 4%. Investors were particularly alarmed by the suggestion by Fed Chairman Jerome Powell that the ultimate level of interest rates will likely be higher than the Fed's earlier estimates. By ultimate level, he was referring to the so-called terminal Fed funds rate, which is the peak level of rates at the end of this tightening cycle. For much of the past year, the Federal Reserve has been steadily revising up their projection of how far interest rates will have to climb. With easing supply chain shortage, what does the Fed see in the economic data that causes them to think that ever higher interest rates are warranted? Where are interest rates heading? How high is high enough? What does it mean for the bond market, the stock market, and the US dollar? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about major global change. Welcome to the Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you'll be notified when a new video comes out. Central banks, including the Federal Reserve, are raising interest rates for just one reason: fighting inflation, of course. Over the past month, inflation reading has been generally coming in higher than expected, whether it's in the Euro area, the UK, Canada, the US, or even Japan. Indeed, the magnitude of inflation surprises in September among these countries was the highest in 4 months. Can this just be a one-off, or is it telling us that there's something new going on? To answer this question, let's take a close look at the data. Consumer price inflation readings in the Americas are generally off their peaks. However, except for Brazil, the pace of decline has been quite slow. In Europe, inflation is still moving up, except in Russia. In Asia, inflation is climbing in the 3 largest economies, albeit from lower levels. It is interesting that headline inflation has not eased more, given food prices have dropped for 6 consecutive months and are now back to levels prior to the outbreak of the Russia-Ukraine war. So is, of course, is oil price. Looking at core inflation that excludes food and energy tells us that the reason is because the global inflation story is broadening out. Whether it's in the Americas, Europe, or Asia, core inflation is either edging up or stuck at high levels. The only country where core inflation is low and falling is China, where the economy has been battered by continued lockdowns and a collapse of housing activities. The stickiness of core inflation is at odds with clear signs of easing global supply chain that should be associated with moderating inflation for tradable goods. The Phillips curve is the primary framework for understanding and forecasting inflation used by central banks. The basic idea is that there's an inverse relationship between the unemployment rate and inflation. That is, the lower is the unemployment rate, the higher would be wage growth, and the higher would be inflation. Over the past year, except for China, the unemployment rate in the largest economies in the world fell, and by quite a lot in many instances. Moreover, for many countries, their current unemployment rate is at the lowest level over the past decade. These countries include the US, Eurozone, Switzerland, and Australia. Given the unemployment rates are low and falling, the Phillips curve tells us to expect high inflation. Economists use the Phillips curve to estimate the so-called non-accelerating inflation rate of unemployment, known otherwise as NIRU. The idea behind it is that if the actual unemployment rate is below NIRU, inflation will rise. At the moment, using the OECD estimates for NIRU, with the notable exception of Germany, the unemployment rate of most of the major developed economies in the world is below NIRU. In other words, we should expect higher than average inflation, especially in countries where the unemployment rate is much lower than NIRU. The bottom line is that for inflation to go down, we need to see the unemployment rate go up. There are 2 ways, of course, for the unemployment rate to go up. Either workers get laid off, or that people who are not in the labor force decide to start looking for work. In most countries, labor participation rate has returned to their pre-2020 levels. This means things have gone back to normal after the lockdowns were lifted, and there's no extra cushion in the system that can ease the tight labor market. One exception to this is the United States, where the labor participation rate is still about 1 percentage point below where it was at the start of 2020. If all of a sudden, all the people in the US who left the labor force during the lockdowns were to return to the labor force, it would ease the tightness of the US labor market considerably. The problem is that there are no signs that this is happening or even going to happen. Indeed, this is the biggest puzzle about the US economy and arguably a source of great consternation for the Federal Reserve. Last week I suggested this could be due partly to skill mismatch, meaning too many people who left the labor force simply don't have the skills to qualify for the 10 million job openings right now. Well, there are of course other explanations. Massive wealth gains since 2020 have allowed some people to take an early retirement. There is potentially another explanation. The US has one of the lowest vaccination rates in the world, at just 67%. Is it possible that some people decided that they would rather quit their jobs instead of getting vaccinated? Or is it possible that there are more Americans than people elsewhere who are suffering now from the long-term effects of catching the disease because they didn't get vaccinated? I don't know the answer, but I do know the US economy is missing at least 3 million workers, and this is placing great pressure on the Federal Reserve to keep raising interest rates. Whether it is skill mismatch or low rate of vaccination, unit labor costs in the US are accelerating at their highest level in nearly 40 years, reflecting high wage growth and lower labor productivity growth. Amazingly, despite the labor shortage, American companies, especially the publicly traded ones, are scrambling to bring jobs back to the US as they fear a further escalation of trade tension between the US and China. In Europe, labor shortage is perhaps less acute, but almost every week we see new industrial actions by workers seeking higher pay to compensate for the erosion of their real income by the US-led sanctions against Russia. All this means is that all else being equal, high inflation is here to stay, especially in the United States and Europe. This is unless, of course, central banks are prepared to go all out. I suspect another source of frustration for the Fed is that they have not gotten more help from the financial markets. Financial markets are the main channel through which Fed interest rate hikes can affect the economy. So far, the impact of the Fed rate hikes has not been very great, as financial conditions remain closer to neutral than tight. The great irony of 2022 is that investors are so afraid of missing out on the Fed pivot trades that they are making the Fed's tightening less effective than would have been otherwise. The irony is that if this cat and mouse game goes on for much longer, interest rates will have to overshoot, and the chance we will get a soft landing becomes nil. The reality that the market does not want to accept, and that the Fed will never admit publicly, is that for the Fed to succeed in quelling inflation, we will need to see more wealth destruction. With the financial windfall of the past 3 years, US household wealth is still higher than its pre-2020 level by nearly a whole year's income. This is supporting consumer spending and stopping some people from going back to work. All this means is that interest rates are likely to overshoot, in that both bonds and stocks have more room to fall. It is quite incredible to me that US corporate profits as a share of national income is back to the extreme high level just before the start of the Great Depression 90 years ago. It is difficult to see how this can be sustainable given the rising unit labor costs and rising interest rates. Stocks are down 20% this year, but this does not make them cheap. Bonds are not expensive, but they might have to get cheaper until stocks become fairly valued. The dollar is very expensive, but it is too early to sell it while the Fed is still on a warpath. Energy is not cheap, but it is the only market that provides real hedge against proliferating geopolitical risks. Who says investing is easy? If you got something out of this video, please hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, come check us out at davidwuunbound.com. Thank you for listening.